Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures pages on the screen now. These can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both positive and the negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. The securities discussed herein do not represent an entire portfolio and in aggregate may only represent a small percentage of a strategy's holdings. The issuers discussed may or may not be held in Crescat's client portfolios at any given time. This video is not intended to be, nor should it be construed as an offer to sell or a solicitation of an offer to buy any security. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. So let's get started. If you want to learn more about our strategies, please do reach out to Merrick. We encourage you. His contact information's on the screen now. We'll show it again at the end of the video. So let's get started. So yesterday, finally, we had some cracks in the Magnificent Seven. Unbelievable, but I don't think anyone would imagine that this was possible. But of course, we've been thinking it's very much possible and highly probable. And we got the first taste of it in a significant way. This what we've been calling for, this great rotation out of overvalued mega cap tech and other overvalued financial assets and into undervalued commodities and commodity equities. We saw a glimpse of that yesterday for sure, in a significant way. And this is a heat map of the S&P 500. It's organized by sector. So it's also, it shows the percentage that the stocks were down. And the size of the squares is related to the market cap of the stock. So all the stocks in the S&P 500, you can see how overweighted the Magnificent Seven stocks are. And you can see they were all down yesterday significantly. And lo and behold, many of the other stocks were up. And this is kind of the exact opposite of what we've been seeing in over the last year plus, where we've seen the leadership just getting narrower and narrower and narrower. And there's actually been a number of other stocks that have been in the S&P 500 that have been down, or we've seen many days where there's a narrow group of stocks up and even more stocks down. And yet the overall index is up because the heavily market cap weighted large cap tech stocks are the ones driving the overall index to be up, even when there's more stocks that are down. Well, that was the exact opposite yesterday. Index was down. The Magnificent Seven stocks were down significantly, and the broader market was actually up. Now, we're not necessarily calling for the broader market to everything else to be up besides the Mag 7 like it was yesterday. We're calling for more of we are calling for more of a significant bear market in the S&P 500 at large, and a more narrow group of leadership to emerge in the commodity and commodity equity sectors. And we did see that yesterday too. Yesterday was just, I call it the first day down for the S&P 500. Today's for the Mag 7. Today's a bounce. Anyway, let's go on to the next. So what's going on? With the Mag 7 earnings growth, we can see that the growth rates have been really strong for some of these leaders like NVIDIA, Amazon, and Meta, and Google. In the last year, they had in the first quarter they had enormous growth rates, but now those growth rates are decelerating. Apple is a company with a $3+ trillion market cap that's actually had like five out of the last 6 quarters already negative year-over-year revenue comparison. So that one hasn't been growing at all. and it's still way up there, most valuable company in the world today. And now there's this hope that with AI, which they missed the boat on AI, but now they're going to adopt Chat GPT and come out with some new features in the next generation of the iPhone. And there's hope that that's going to get their growth rate accelerating to barely be above inflation here. But Tesla, we can see the earnings growth has already turned negative, but the point is, at the peak of the business cycle, especially with the AI enthusiasm and hype, there is real growth and real activity being driven into these stocks, but it's over extrapolated in terms of how those growth trends are going to continue, and that's what creates the top, especially when you stack historically high multiples on top of it. But when you see the earnings deceleration coming, and it has a lot more to decelerate, but you already see there's this earnings deceleration in the next quarter, and that's the formula for a top. Let's go on to the next. So we're looking at the S&P 500 earnings estimates for the S&P 500 versus the economic surprise index. So the economic surprise index, Tavi's shown this chart and other similar charts, has been diverging. We've shown it, diverging relative to inflation expectations, which have been going higher in spite of the good CPI yesterday, which is a backward-looking thing. We want to consider inflation expectations, which are unanchored and uncontained right now. But so that's showing the stagflation. But this chart is showing how the earnings estimates are still way up there. So there's this hope, there's this extrapolation of the growth on the recent hype, and yet we have all these other recession signals. The inverted yield curve, which is starting to uninvert now. The uninversion is the trigger for the recession, and the economic surprise index here. But we think those earnings estimates are too high, and they're going to be coming down, just like the surprise index is suggesting. Let's go on to the next. This is looking at the correlation between the U.S. economic surprise index, the same chart we were just looking at, and the S&P 500. And what it shows, if you compare it to other time frames, like in 2007, like in 2015, like ahead of the COVID crash in 2020, you can see normally these two things are positively correlated. But when they're negatively correlated, like those times I just flagged, and like today, what you usually see is that the negative correlation is driven by the economic surprise index, turning down, and stocks not cooperating, stocks not wanting to agree with it, until lo and behold, you get the real market crash or correction and the recession. And that's kind of where we are again today. It's just another one of these economic timing indicators that is showing that we are getting ready for a significant correction in the market, if not a crash. We have excessive valuations. We have the declining economic surprises. And so when this thing turns positive, what does that mean? That's when the correlation is positive again. And those are times like in 2008, like in the COVID crash in 2020, like in the market meltdown in late 2015. Those are times when stock prices also start turning down and the correlation turns positive. Let's go on to the next. So this is another chart showing now the overly optimistic earnings, growth rates, and even though we've shown how they're decelerating now, and we have all these other macroeconomic timing indicators and economic surprise index, but what are all those earnings estimates? They're still way up there. Analysts are overly optimistic. They're still looking for 17% earnings growth in the S&P 500. We do not think this is possible at all. We think these estimates are going to start coming down with this earnings season just starting now. We think it's ripe for more, downward guidance, more negative surprises. People say they like to see the beat and the raise. What does that mean? They beat earnings expectations, and then the company raises the guidance and the analysts raise their earnings estimate. We think we're getting ready for the exact opposite, an earnings season of more negative surprises and more downward guidance in expectations due to all the macro setup that we've talked about. So that's it for me today. Let's go on to Tavi.
Found it. All right, let's get started, guys. Sorry, I was looking for the microphone. Guys, I want to start with an exercise instead. And you can see here, let me be blunt to the changes I've done. You don't know what chart this is, number one. And you also don't know the time frame. I put the time frame as of now, but it's really not. And the question to you is, would you buy this chart? Would you sell this chart? It's such an important exercise because looking at this, it just seems like there's structurally a problem with this security, whatever this is. And the matter of fact is that, what if I tell you this was one of the best setups for an opportunity ever, potentially, in terms of this asset class? This was down, way over double digits, or I shouldn't say triple digits, but like high double digits. And still, imagine trying to defend your thesis, looking at this chart and telling an institution or institutional client, or even if you're a central banker, and trying to make the point of why you should be buying this asset. Now, let's see the next chart. The next slide reviews what this is. This was gold from 1981 to 2001. The security was down, or gold was down 70% during that time. If we go to the next chart, we can see the subsequent period from 2001 to 2024. And you can see here, this was by far one of the best times we've seen to invest in gold. I just think this puts into perspective what we're seeing in a lot of the securities that we've been investing in this space. If we go to the next chart, would you then buy this chart? This is actually the time frame I'm showing you is true, meaning this is as of now. We've been seeing a downward movement in this chart since 1995 all the way to 2024. People have lost faith in this chart. People think this is a chronic problem with this, should I say, industry, or is it not an industry anymore just because it's so beat up? Liquidity is gone. Nobody invests in the space. We don't even have professionals that want to come in and work in this space. I think you know what I'm talking about, but let's go to the next chart. What I'm referring to is the miners to gold ratio. A lot of people think that the miners will never outperform gold because it just hasn't for the last 20 years. I just showed you a chart in which it showed the exactly same time frame of about 20 years of a security that has gone nowhere but down throughout that whole period. I don't remember a time in history that gold has been down 70%. So just to give you a sense of how much of an extreme of a movement we saw during that time. A lot of people had the faith that gold would have done well during that period because it was, we had the break of the gold standard, and then gold did really well in the 70s. Imagine being caught up into that whole narrative in the 80s and losing 70% of your money if you invest just in gold all the way from to 2001. This reminds me of today in this mining space. And in my view, there is a multitude of technical setups in this industry right now that I cannot recall personally a time that I've seen that. At the same time, most people were just ignoring, neglecting, and just choosing to look away. And to be honest, if you want to be bullish in gold, and I feel like I just hear crickets. I mean, there's really not a lot of folks still defending this industry. Even if we go to conferences and we speak with other folks in our own realm of professionals, we can clearly see that the narrative not only has shifted over the general investors, but now clearly as well within the industry too. And to me, this is the same setup we saw with gold. It's what we're seeing today. And would it surprise you if we see something like we saw with gold from 2001 to 2024? It wouldn't surprise me. I actually think that that's a very likely scenario, and probably how things will unfold in this coming decade. Let's go to the next chart. Let me give you a sense. This is just throwing a line on top of this chart. If you're a technical analyst, you would appreciate the fact that since 2015, this chart has gone sideways, as you can see in this chart. And recently, when I mean recently, I mean this week, we've actually started to break out in this ratio. And I should actually give you the calculation. It's just looking at the Philadelphia Gold and Silver Index, which everyone has access to. And I'm dividing by gold prices. So my apologies for not having, I usually have the calculation of the ratio there just to help you understand what I'm doing. But clearly you can see that not a lot of people think that the miners, the gold companies first will follow gold prices. And number two, that they actually maybe could have leverage over gold's performance. This has been sort of unusually difficult to support the thesis that if we see a gold bull market, we would see this breaking out. That's my view, but majority of people would disagree with me just because in the last 20 years, we didn't see that. That's just such a wrong way, in my view, of seeing this, because I just showed you a chart of gold in which we saw the complete opposite 20 years after hitting that bottom. To me, this is like a perfect technical setup. Now, let's go through that multitude of technical breakouts that we're seeing in the mining industry. Let's go to the first one. This is one, junior miners. So we were looking at the bigger miners. Now we're looking at the smaller miners. Here is a 14-year downward trend, started in 2011. This was when gold peaked at that time as well. And now we're above those levels. But the miners are so far still from those periods, although they're making money as basically generating as much cash flow as they were back in those days. They look a lot healthier. But for some reason, people want to support the idea that fundamentally they shouldn't be justifying allocation of a portfolio into the space. But if we look at the riskiest part of this market, the junior miners, in which, by the way, the companies we talk about in this presentation don't even have the luxury of being at the GDXJ to somewhat benefit from a little more liquidity than other vehicles. And you can see here that even in that sense, we just broke out from a 14-year downward trend. And looking at the prior chart and now this chart, it gives me the belief that maybe this is the beginning of something. But maybe let me try to convince my argument over this next following charts. Let's go to the next one here. And so the next one now is looking at candles. We're doing monthly candles of the GDX. So now it's not a ratio. It's just looking at the actual performance on a monthly basis by candles of the GDX, which a lot of people would argue this is more of the senior part of the industry. Senior meaning those are companies that have already generate either production and mostly actually have cash flows. You can value these companies very different in the junior space because you can discount the cash flows of those companies, and instead of the way dealing with exploration companies that work a little bit different in terms of how we value those. But you can see clearly that even from that basis, the same chart of 2011, that peak that we saw, and you can see here 2010, 2011, we kind of stay at that peak for a while. And that really formed that beginning of the resistance. Then we had a massive crash all the way to 2015. And then we finally hit a bottom there. And we started to form higher lows, as you can see in this chart. So the first low was in 2018. And then we had the COVID lows. And then we had in 2022 another low. Recently, this year, actually, we had another higher low in 2024. And then we broke out. And now for the first time on a monthly basis, this is the first candle, and this is the beginning of the month. We're, July 12th today. This is the first candle that if the month was ending today, we would be breaking out from this chart. That's something to be aware of. Let's go to the next chart now. The next chart now is showing just a GDXJ. Again, no, we're not doing a ratio anymore. We're just looking at the GDXJ now. The GDXJ, for those who don't know, the J just means juniors. Although there are some senior or bigger companies as part of this this ETF, we do have smaller companies relative to the GDX, so they carry a little bit larger risk. And even from that basis, as you can see here in this chart, clearly this is even better than the prior chart. This is, to me, even more evident that this is a real breakout. So you can see here, the line has touched this resistance multiple times, not once, multiple times, particularly since the COVID first upward movement we had, that we hit that resistance, formed that kind of solidified this downward trend. And then now we've been also forming higher lows. And finally, we had a breakout 3 months ago, and we're solidifying this movement now for the third candle, as you can see in this chart, which appears to be the beginning of a much bigger move, in the initial phases of a much bigger move. Let's go to the next chart now. Now, let me show you another one, silver, because this idea that we are potentially in the bull market for gold. First thing that comes to my mind is silver, obviously, because if you are of the view that this is a long-term cycle for the metal, it's just hard to believe that we won't see silver also taking the lead on performance basis. And we've seen this in the past, and a lot of people are skeptical about this chart because of the frustration of the metal not moving for so many years. As you can see, there's been a very long consolidation, and it explains as well the skepticism in the mining industry too, because silver and the miners are not too far. Well, although we did see gold break out first, silver is doing, as we speak, is doing something which appears to be very special. And the third one now, it's been the miners, the gold and silver miners, the copper miners, they're starting to move as well in a substantial way. And in my view, this is really just the beginning. I mean, the money is flowing, and the funnel of capital is flowing down the industry. It's coming in. It's definitely streaming down to the smaller companies, and eventually, that's what creates an M&A cycle. That's what creates a speculation in this industry. That's what creates liquidity for those who have been investing and accumulating shares of cheap, high quality exploration assets. Ultimately, that's what this all, in my view, will translate into. Let's go to the next chart now. The next chart now is showing a little bit of a different thing. Everything has been sort of breaking out. Now, let me show you a breakdown of a chart, which still is extremely bullish for those who like to invest in precious metals. I've shown this chart about gold to silver ratio. And the importance of this chart as well is that historically, this is one of the highest levels we've seen of this ratio in history. We broke out of a 13-year support, as you can see there, which was very significant. And then recently, we actually went all the way up and retested that line. A lot of people came out and said, the silver is due for a major correction and all sorts of things that we heard. And guess what? We're starting to move all the way in the direction of this ratio once again. And in my view, this is the beginning of a movement, not the end of one, just like the prior charts that I showed. And I think they're all aligned. It's not, in my view, it's not a coincidence. It's really, it's actually a setup. And so for those that have the conviction to stick with the plan, stick with the idea, stick with the thesis, I think are going to be the ones really taking advantage of this macro scenario. Let's go to the next chart. Silver demand, I think was William from Discovery Fund posted this chart of Bank of America showing silver demand for solar panels And I think this chart is valid and really interesting. But you know what I thought was really fascinating is the fact that the demand for solar panels, you can see back there in from 2016 to 2022, this chart has kind of gone sideways. And then we have a jump in estimates now, and actually the first bar that is a big jump is 2023, as you can see there. But then the estimate of 2024 is also another jump, and it keeps jumping from estimate to estimates. But if we just assume 2023 as our base for all this and so forth, it's fascinating that it's close to 20% of, if you take the total supply, how much we're producing of silver on an annual basis, and we take how much of this has been used as a demand for solar panels, it's about 20% of that. And if we go back to not too long ago at that period that was basically stagnant, it was below, it was below 7% actually. So you can kind of see the exponential growth, and who knows if these estimates are accurate. Potentially they could be understating the growth that we could see in silver as well. This is not even to say the monetary aspect of owning silver in a gold bull market potentially, and the benefit of that in terms of performance. And so this chart is interesting from another alternative of demand that is certainly becoming stronger of an aspect for silver as well. But I think there's a lot of other things as well. So let's go to the next chart. So, I spoke this the other day, and I do think this is this a little bit shocking. I think it requires a lot more research than saying the technological advancements have allowed the mining industry to not really have to spend a lot of money and not use a lot of labor. I think there has been some of that. The argument can be used as efficiency reduces capital, the capital intensiveness, and also the number of people that need to work in a mining company. But this chart basically is looking at something called private fixed investment, which is when you have a GDP. That's one of the calculations you use, is to look at fixed investments from privately, not from the government. And those are usually fixed investments, are investments over the long term and so forth. And you can see, you can break it down just mining as a percentage of overall GDP. And mining used to make up close to 17% of this economy back in the 60s. And you can, even in the 70s or 80s, it was about 10% of GDP. Today, it's at 0.3%. Now, this to me speaks volumes to the opportunity, the fact that I think there's further explanations on this, and maybe even Quentin should comment in his segment about this too, because I think I would love to get his take on it. But I think this has a lot to do with globalization too. The fact that we've been running away from a highly globalized environment that we've had all the way from the 70s, 60s, particularly from the 90s to today. And as we see those things changing, it's just hard to believe we're going to continue to just import metals. And we're actually going to probably see this as a critical industry. It's crazy to think that we think of AI and other things as critical, but not the actual materials that allow us to advance those technologies. And so, to me, it's just a matter of time for us to really start seeing the overall industry of mining again being seen as a critical part of the economy. And so this 0.3%, it just comes to my mind. Well, what if we just double that? How much money is that going to be flowing into this industry? But honestly, I think we could see a lot more. It's another one of those charts that reminds me of the gold chart going back to 20 years, that we just see an industry that basically lost interest from investors for a secular basis. And this is basically what's happening here. Technology has taken such a form of the global economy, but really the US. And I think we've swung too far in that direction, and potentially capital needs to flow back in order to have a civilization. I mean, I don't think we can survive in a deglobalized environment and continuing to ignore this industry as a critical element of society. Let's go to the next chart. And so what is a macro shift? A macro shift as well is seen in this commodity prices. And it's interesting to me that this is not just one part of those changes. I mean, we've seen so many things change since the COVID, and commodities have broke out since the policymakers' response towards the recession in the lockdowns and the pandemic period. We've had a fiscal stimulus to the wazoo. We've had interest rate cuts. We saw all sorts of measurements. Inflation Act being passed. We saw an infrastructure act. We saw a war breaking out. We've had things like the Japanese yen collapse and used to be the safest currency in the planet. We started to see value companies, not growth, starting to do better. We started to see some emerging markets doing better. Those are all important changes. We saw volatility in the treasury market. When was the last time we saw this type of volatility in the treasury market? Maybe just in the 70s we would be able to use that as a period. And so all these things are certainly I think impacting these macro regime shift that I believe we're in. And if you look at this chart right there, after this breakout that we've had in commodity prices, an equal weighted index, we've been consolidating for a while now. And this is why I tend to not overly focus on the CPI number and all these things that come in on a monthly basis, because I do think inflation is incredibly entrenched in the U.S. economy and other developed places. And this chart is another way of seeing this. Let's go to the next chart. Next one is showing another way of seeing this regime changes on the 2-year yield. The 2-year yield, all the way back to the 80s, really. Every time we bump into this resistance, recession. So double dip recession started over there, and then we had the tech bubble, major recession there as well as we hit this line, and then we saw the housing bubble. And basically, this is sort of a response towards leverage, right? Because yields are falling and debt is increasing. That's basically what was going on. A higher manipulation from central banks, or I should say higher intervention from central banks in markets from different vehicles. And if we think about how much has policy making changed since just the global financial crisis has been really, I think, instrumental to see the suppression of volatility and all sorts of things that we've had over the years. But since then, we actually broke out from this resistance finally, which to me, that just means inflation. We're in a different era now. And it wouldn't surprise me, even myself, who's in the inflation camp over the next 5 to 10 years. I look at this chart and I see people going from 7 price interest rate cuts in the curve all the way to 2, and people really have disbelief that we could see yields moving lower. The same folks that said there's no way the Federal Reserve could raise interest rates all the way to 5.5% are now saying that the Fed cannot reduce rates because of inflation. And in my view, while again I am of the inflation view, I do think that ultimately what matters is going to be the cost of the debt for the government. And that's the main role of the Federal Reserve. And we'll be emerging into that role over time, just like it did in the 40s because of the extreme amount of government debt to GDP. And I think this is going to be the case here as well. And very likely, it wouldn't surprise me at all if we see this chart retesting the 2% level, which would be forming now, instead of a resistance, would be creating a support at that what used to be a resistance line. Let's go to the next chart. The next chart shows a chart from Increment and AG. Ronnie Serfole actually has been sharing this chart, and I think it's a phenomenal chart. It gives you some sense of that we could see stupid gold prices in this environment. The idea really is just looking at Fed funds rate. When the Fed starts to cut interest rates, they get into an economic problem, and it forces the hands of central banks to reduce and cut interest rates. While a lot of people see that as a spurt of potential growth given the liquidity, that's not usually what happens. Those more recent takes that we're hearing that interest rates cuts are positive for equity markets, it's really not my view either. So, but you can see that the performance of a hard asset, the performance of gold as a not only an alternative but really a defensive asset is second to none, and it's just outstanding. And it wouldn't shock me at all if we see much higher prices that actually are similar to those growth rates that we've had in the past. And you can throw estimates of a median of the 31, 39, and 5% growth, and we could see some real impact in fundamentals of mining companies if we see prices substantially growing from here. Let's go to the next chart. Lastly, going back to a little bit of the yield idea and analysis on yields, you can see here, I think one of the most important developments happening today is the last, I guess, this whole week, it's been the steepening of the yield curve. The steepening of the yield curve is something that a lot of people also thought it wasn't possible to see. Maybe, I love when people start saying this is maybe this is a new normal, that we're going to see just inverted levels for much longer than usual. Folks, we've been inverted for the longest period in history. This is the time to be betting the other way, in my view. And so what we're seeing in this chart is that is the 2-year versus the 3rd-year yield. We can see here that I sort of had it's saying there the arrow showing the steepening phase. But what is more important about this is that we're seeing sort of some parts of the market move in one direction, showing that interest rates are supposed to be higher for longer. We're probably going to see profitability becoming more and more of a more and more of a prioritization towards investors, that we should be perhaps looking at commodities again, that we are seeing a gold rush of central banks accumulating the metal, and all sorts of things that are happening, the deglobalization trends, populism, the inequality problem. And then people come up and say, well, we're probably, these are all, maybe real trends in the future, but VIX and volatility and financial stress should be suppressed historically. And I'm not of that view at all. I think that there's a lagging effect of overall cost of capital rising into volatility. And I think the clock is ticking faster. And I think we're getting really close to a change in volatility profile here in equity markets in the US. And so this is just to show you a few of the other times when we had steepening of the yield curve. And the steepening of the yield curve is one classic recession signal. And a lot of people are dismissing this. And I have one word for it: complacency. I think that's the word to describe what's happening with the expectation of financial stress and volatility staying lower for longer. That is not my view at all. Let's go to the next chart. I'm almost done. You can see here another way to look at this that I think it's a very interesting way is certainly the real Fed funds rate versus the S&P 500 earnings yield. And you can see that this difference between the two. So the red line is basically saying how expensive is the equity market. And essentially every time the red line falls, the markets either get really expensive or earnings have been completely crushed. It's one of the two. Majority of the times outside of the global financial crisis, the reason why the red line is falling has to do with the fact that equity markets are too expensive to how much money those companies make. That's essentially what the red line is showing you. The white line is showing something different. It's showing the cost of capital. And it's one way of measuring cost of capital. Of course, cost of capital, you should also look at equity, risk, and other things. But this is looking at debt, essentially looking at Fed funds rate relative to CPI. And you can see that we're above CPI on the Fed funds rate, basically double the amount of Fed funds rate today, of CPI rate. And the only other time we've seen this was either at the very peak of the market in the housing bubble, or back in the tech bubble peak as well, in which, as you can see, the earnings yield and the real rate of the short-term Fed funds rate here was, basically eclipse that line. And so right now we're not too far from that. So I'll definitely consider this chart as another way of a parameter for risk. Let's go to the next chart. I think I'm almost done. And another thing you should look at is the timing, the lagging effects of interest rates into the economy. And this chart's great because it shows that bankruptcy filings are starting to pick up. This is the largest monthly change since the COVID crisis. And you can see here, this is starting to show some signs of an upward trajectory. And if that's the case, that's when you start seeing big downturns in the economic data. And not only that, you could potentially see the 2-year yield going back to 2%. This is the case that you could see that 2-year yield going back to its what used to be resistance, now it's going to become, in my view, support. Let's go to the next chart, because if you dive into this, you're going to see that consumer discretionary is the largest sector actually filing for bankruptcy, which begs the question, why? And the answer for that is because consumer discretionary has never been this levered. Since the COVID recession, most of consumer discretionary sector and companies have really levered up. And that's why we're seeing the rolling of that debt at higher interest rates is causing some of these companies to go out of business. Let's go to the next chart. I'm almost done, promise. Last one is Quinton made a comment about the Dow Jones in gold terms. I thought this was a good chart to be created. So I looked at, historically Dow Jones, just because it has longer history. It's not because I picked Dow Jones. You can see the S&P 500 will show similar signs. But it's remarkable that we're basically trading in the same levels we were back in 1929 at the very peak. The difference is that recently we've had a justification perhaps for running into extreme multiples in equity markets. And that justification potentially could have been that we were in a NIRP environment, or a near zero interest rate environment. That is not where we are today anymore. We're at 5+% interest rates. Most corporations can't even borrow money at that rate. They have to borrow money at least at double that amount. And so, I would suspect that, the risk and the fact that people are just overlooking this chart and saying, it's a different environment. It's not anymore. We're back to the game where interest rates do matter. And we're going to start seeing changes of how we value companies over time as well. So profitability, I would stick with that view. Profitability will start mattering again. And I don't think we're too far from that either. I think this is my last chart. Just confirm that, if you don't mind. Next chart. Can we go next? Nope, that's it. All right, Quinton, why don't you take it from there?
All right. Yeah, Toby, when I pointed this out, what I was looking at is what's happening right now, like the pattern, and it's kind of gradually softened over the past decade or so. It looks like back in the Nifty 50 era. See the Nifty 50 bubble?
Yep.
See how that pattern looks like it could just, like fall off a cliff? I don't know. Looks similar.
Hallelujah.
You're on mute.
Oh, sorry.
Time.
I was going to say, would that surprise you that would have happened? I mean, it's
no.
It's
That's
fascinating, isn't it?
That's why I'm pointing it out. Is that
I think you're right.
I think we're on the cusp of that, but whatever. Okay, let's
I agree with you.
jump in here. I got. I'm gonna, as a geologist, I'm gonna do my darndest to talk about something big today, and I'm doing it because in the context of mining investment, it's pretty important to understand certain things that are going on. Okay. And this is a geologist speaking. Okay. I'm going to use that disclaimer first and foremost. And hopefully my internet does not puke out on me. I found out, I think what I found out is that my computer that I do the videos from hasn't been updated in so long. It kept trying to update in the background, and it was blanking out my connection. So I had to shut down and then reload all of the different updates and blah, blah, blah. And then I had to, join again here. So apologize for dropping off there for a bit. Hopefully this works now. Anyway, look, before the pandemic, the world was heading to kind of a globalist or global picture. Okay. We were definitely heading towards a global picture. And yeah, it's complicated. There's a lot of countries. There's a lot of different stuff going back and forth between countries. But by and large, it was straight line. It worked. Okay. Even though this picture looks a bit hairy, the supply chains were intact. And, aside from the complexity of it, they worked. Okay. We'll just say that it formed a picture like this. But let's go to the next slide. And unfortunately, that ball of strings has now collapsed, in my view. It's collapsing. Okay, there's definitely some fundamental changes going on right now, and all of those strings are they've just kind of knotted up like a big ball of Christmas lights. You ever watch Futurama when Leela gives Fry a ball of Christmas lights to untangle to distract him. That's what I feel like. I feel like the global supply chain has basically gone to heck in a handbasket. Okay, so I want to talk about this because it actually relates to some of the stuff that Tommy just said, but it also has a bearing on mining investment and where we're headed. Okay, all right. So go to the next slide. Okay, this is it again. These are my views. Disclaimer. Okay, but there are countries that are commodity suppliers out there. In other words, there are countries that generate the stuff that we need. There are other countries that are dominantly manufacturers. Okay, like China, and then there's countries that are consumers, like the United States, many European countries, and so forth, that are basically debt-based dependents. Okay, at this point in time, in this point in history, we here in the United States have basically offshored our mining industry so that it's such a small part now of the overall economy that it's almost meaningless in some respects. Okay, all of that metal production has been shifted over to other countries where pick your favorite country, Peru, Chile, Papua New Guinea, Indonesia, whatever. It's definitely gone overseas. Okay, but I would argue that there's at a fundamental level, there's three types of countries out there, and those are the three types of countries. All right, now over time, mining and manufacturing has migrated from developed countries to less developed countries. Now you say, well, gee, duh. Okay, why? Well, wages is one factor. Okay, as people in developed countries expect higher and higher wages, it's going to be easy to manufacture stuff in countries that are less developed because people aren't going to expect such high wages. I mean, that's a very fundamental thing. It is what it is. So, you've seen that kind of, the sucking sound is, who was it? Perot, I think, used the term. It indeed happened. It's a natural phenomenon. But also the mining industry in particular has offshored, like copper production. Yeah, United States, it still has a pretty decent amount of copper production, but it has so much more potential. But there's been conscious decision not to expand copper production. In fact, if anything, I would argue that there's been a serious effort to dissuade new copper projects from going into commission in this country. And it's pretty tough to see as a geologist. I like to see new mines get built, but look at Resolution in Arizona. It's been sitting there for 30 years now, I think, since it was first drilled. Ain't going anywhere. Pebble in Alaska, et cetera. So I could fill in the blank, but you get the idea. So mining has basically migrated over to less developed countries for various reasons. Okay, now, where's the real wealth in the world created? Okay, it's not really created, in my view, from service industry and stuff like that, banking, whatever. Banking seems to be kind of a lecherous, leechy aspect of the overall global economy. It's really, the wealth is created by the countries that are mining and producing resources and manufacturing things. Okay, all right. So that's where I think I think it's becoming more apparent that the wealth is created overseas. Okay, countries that produce minerals and goods now want to protect that wealth. I would argue the big shift in geopolitics that we're seeing today is right there. Okay, it's a very fundamental desire amongst commodity-rich countries, manufacturing, rich countries, to protect that wealth. Okay, they don't want to give up, all the wonderful things they have. It's that simple. Okay, let's go to the next slide. Okay, so what on earth has been happening lately? Particularly in the past 4 years. It's not just the past 4 years, but it has accelerated. We'll say. Okay, I think you're starting to see what I call debt-based dependent countries. Countries that need to issue debt to pay their bills are increasingly at risk of losing access to resources and cheap goods. If there's any message I have for people in North America, U.S., Canada in particular, wake up, guys, because we've been living high in the hog for a long time, and it's entirely because we have the power to issue debt. Okay, and yeah, it's kind of it's almost a game in my view. It's a bit discouraging to think that we've kind of bamboozled our way into the wealthiest nation on earth when we should have done it by creating wealth through other means. Okay, I'm not saying we don't produce anything, but come on, man, where's mining? Where's we should be growing our petroleum industry. We should be growing a lot of things. Okay, now here's where it gets interesting. Manufacturing-based countries want to protect their industries and increase wealth for their own citizens. I put this in there, and it's very, very direct. Okay, because there is one country, and I'm pretty sure everybody watching this video can name that country that wants to protect their manufacturing base. Okay, China. All right, China is the manufacturing powerhouse of the world. They want to protect that, and they think very differently, very different strategic way than most other countries. Okay, the way they see it is, hey, if we can control commodities in particular, we can control the industries. In other words, they can control the manufacturing space that they currently have, the industries that they have, by exerting control over commodities. It's that simple, okay? And they want to do that to protect their own wealth and the good of their own citizens. All right, countries that supply resources want more benefits from these, whether it be directly or through taxes. Okay, a lot of undeveloped or lesser developed countries, they want good things for themselves. Okay, they know they're resource rich, and they want good things. They want a direct ownership, and I'll talk about this in a minute, in mines and in smelters and in fill in the blank. But they also want things like taxes. Okay, taxes are probably the easiest way to capture a lot of value that's being generated by the resources they produce. Okay, and all of this combined has led to a trend that globalism is largely fallen apart. Okay, I think the whole momentum, the whole move towards globalism, ain't gonna happen, guys. It ain't gonna happen, and I'll show you some reasons why here in a few slides. Okay, go to the next slide. Okay, I'm look again. This is very high level stuff. I'm not giving a super, like, I'm not Tavi, okay, or Kevin. I'm not a macro brain. I just look at stuff on my iPhone and I go, isn't that interesting? Okay, but I'm gonna point out some things that I think many people have recognized recently. Very blatant issues that have popped up in the commodity space. If you look at your iPhone and you look at Kitco, you'll say, that's copper's $4.40. And it was. I mean, I took these two images exact same time this morning. Okay. I think they use the Chicago, I don't know, the CME or something. I don't know what they use. But that's the price that they quote right there. Okay. Then you come over here and you look at copper on Trading Economics, which I think uses LME. Look at that. It's a 20-cent spread, guys. That's crazy. Can you imagine the arbitrage if you could somehow magically take a bunch of copper in London, okay, and just magically boom, move it over to Chicago and then capture that 20 cents? You'd make a ton of money. Okay, but this is a phenomenon I've seen more and more lately, where you're seeing a pretty big spread. And I think it's driven mainly by divisions between East and West. Okay, that's my view. I think China could give two hoots how much. I mean, they care about metal prices, but they're willing to put a little bit more price into some, especially if it's dollars, because they're like, who cares about dollars anymore, right? So they're willing to spend $4.60 a pound, whereas over here in North America, we're like, oh well, God help us, we can't spend more than $4.40 a pound on a pound of copper. That's crazy. Okay, so the Chinese don't give a flying flip. They're going to say, you know what? We need that metal. We're going to capture more of it. We're going to attract it. We're going to attract it to China. That's what they're doing. That's what they're doing. I'm telling you, it's very simple. Okay, I'm telling you that because we happen to own an operating mine now, and I can tell you, I'm going to get the best price for a lot of our product if it goes to China. It's that simple. Okay. Am I gonna take a few $1 million haircut every month because I want to deal with some Western smelter or whatever? No. Okay, so guess what, guys? We better wake up. The Chinese are grabbing more and more of the market. They don't care. Let's go. Next slide. Okay, metal shortages in certain places. This has really led to a disparity of, in the balance of metal. You're starting to see it compartmentalize, and go into certain directions. Like China they're establishing their own supply chain and stuff that's separate from the rest of the world. But because a lot of that metal is falling into that supply chain, it's sucked metal out of other supply chains. Okay, and quite frankly, this is becoming more and more of an issue. So you're seeing an imbalance in metal and how it's distributed around the world as this shift happens. Okay, and I think we're going to see shortages become more and more commonplace in certain areas because other countries are simply willing to put a bit more price or higher price on that commodity and attract it to their side of the ocean. All right. Now, another thing that I've noticed is the smelting industry is just totally turned upside down. Okay, because China, because they want that metal, they built more and more smelter capacity, and I'll talk about that a little bit more here in a second. But because of that, the concentrates are getting sucked out over there. Okay, so what does that mean? It means smelters in Europe or Japan, or I don't think we have any in the U.S. anymore, but other countries that typically smelt, they're having to lower their treatment charges to try to attract those concentrates back over and keep their own ding-dang smelters occupied. Okay, very interesting phenomenon. Go to the next slide. Okay, look, I should have talked to this slide because this is actually the point here. Okay, you're starting to see the smelting industry. Everybody thinks, oh, there's mining and then there's metals, and no, there's a process to get the metals. Okay, and it's called smelting. All right, and the smelting industry is migrating to China and elsewhere. Okay, elsewhere, and then the Chinese are sucking it up. Anyway, look. Look at the new copper smelt. You can Google this on the weekend and just look for articles. But China's new copper smelting projects to add pressure to tighten concentrate supply. Yes, they are, because they're willing to pay a bit more, and they built these humongous smelters that they now need to keep full, and that is sucking the copper out from other places. And so now Europeans smelters and Japanese and so forth, Koreans, whatever, they're all fighting like mad. They're dropping their treatment charges. I got word this morning. Shouldn't talk too much, but hey, maybe the treatment charges might go below zero late this year. Holy cow! They're going to pay us. We don't have to pay for treatment. They're going to pay us, okay? Because they got to keep their smelters full. Is that not crazy? It's crazy. I don't know if it's sustainable, but whatever. We'll see. But then you have other things like this article in the lower right here. Look, people that follow the mining industry know there was a big brouhaha between Indonesia and Freeport and Newmont and so others, years and years ago, because, Indonesia wanted smelting. They wanted that value add component. Give us a smelter. Well, finally Freeport agreed, and they built this ding dang smelter. It's a big doggone thing. It's $3.7 billion at Crescat, I believe is how it's pronounced, in Indonesia. But see, Indonesia realized that by just letting that commodity leave its shores without the value add, it wasn't making as much money. Okay, by having the smelter built in Indonesia, and God bless them. I don't have an argument with that. Okay, I think it's brilliant. Indonesia now makes more money out of the deal. In fact, I think Indonesians are on the counterparty with Freeport on this, so they're going to make that money directly. And quite frankly, I'm not going to argue that these developing countries shouldn't do more of that. Okay, I mean, like, crying out loud, they should develop their own economies and make more money off of their own resources. Let's go to the next slide. Okay, now this is going to make people's heads explode, but it is the God's truth in my view. Um, Basically, China has quietly told the rest of the world. No, it hasn't told. It hasn't told the rest of the world that it's gone offline and it's developing its own supply chains. Okay, you have to kind of read between the lines in most of these articles, but basically China's realized, say in the past 5-6 years, whatever, we're going to forget those Westerners. We're going to go build our own dang mines and get our own metals from however we see fit. Okay, and what they've done is things like gone to Indonesia, work with the Indonesians to build nickel mines out of some of the toughest deposits you'll ever see. I mean, these are metallurgically, they're atrocious. They're high cost. They have lots of nasty chemicals. Quite frankly, they're environmentally unfriendly. But the Chinese need nickel, and they've had a gutful of trying to deal with Western companies and governments to get it. So they've said, "Bugger it, we're building our own ding-dang nickel mines in Indonesia," and Indonesians welcome them because they want to see that investment in Indonesia. Okay, so all of a sudden, the Chinese just built their own supply chain. Okay, and what it's done is it's cratered the nickel price. I mean, it's not like totally zero or something, but the nickel price, which was looking pretty good a few years ago, is now, it's totally upended here, to the point that BHP announced recently they're shutting down their nickel mines operations in Western Australia. Okay, so you have this weird dichotomy where nickel is like the flavor of the day in Indonesia and it's going big, and then you have mines elsewhere shutting down. I've also heard that like the Koreans are desperate to get more nickel concentrates, and they are actually putting money into Canadian nickel company, okay, because they want their own supply chain to keep their own industries going. All right, so this weird dynamics are going on right in front of everybody's eyes. Let's go to the next slide. Okay, if you think the what do we call it, the kerfuffle, I don't know what the word means. Anyway, it's a good word. It really sounds like something big, kerfuffle. Oh, there was a kerfuffle. Anyway, if you think the kerfuffle in Panama a few months ago was really about the environment or whatever, hello, come on. Like, I got to give everybody a dope slap. Okay. It's all about control over the commodities coming out. That's a big mine. Okay. That's a very big mine. Panama is probably one of the West's most vulnerable countries in terms of losing influence. Okay. Guess who showed up? China. Yeah. Guess what they're after? Copper. They got to fill those smelters that I talked about. Okay. Let's stir up trouble. Yeah. Okay. There we are. Okay. Put the pieces together in your head. Oh my gosh. I would argue that, and look, and nothing against Panama, because, they quite frankly deserve a pretty good, component of the value that's created from a mine like this. They also want value out of this. Far be it from us to argue otherwise. Okay, but I can guarantee you that a lot of what happened in Panama was related to control more so than we'll call it noble causes. Anyway, you also see things like you see on the right-hand side here, where a lot of mines overseas, and I could list a dozen of them, like right off like that, are being bought up mainly by Chinese companies. And quite frankly, Western companies are often just handing them over, for reasonable sums. Now you can see here, like Newmont's Achim mine in Ghana. I think the Chinese are bidding on it. Zijin has been pretty aggressive at acquiring stuff. Shandong as well. But it's displacing a lot of the more traditional buyers. Like, you notice right below that, Australia's Perseus. Okay, you think they can compete with basically limitless money from the Bank of China to buy this? No. And do you think Newmont's going to like pick and choose? No, they'll probably just sell it and be done with it. Okay, but you're seeing many mines being bought up by the Chinese. Go to the next slide. By the way, I love the Chinese. It's just communism is a bit of a headbang. Yeah, yeah. So, yeah. Anyway, we won't go there. Sorry. Okay. Mine permitting. This has really changed dynamics in the world. Okay, you have countries. We'll call it developed countries that are, they think they're throwing their weight around, right? Oh, I got debt. I can get these suckers to buy my treasury bond or whatever. So they're foisting this crap on other countries, and the game's over. Okay, personally, but anyway, we in the West have been, like becoming more and more environmentally conscious, or whatever you want to call it, or whatever. That it's taking a crazy amount of time to build a mine. Okay, we're talking like 15, 20 years from the point of discovery to when a mine is built. And you might as well just take your shoe off and, get your Colt and blast your foot, because you're shooting yourself in the foot by doing this. All right. And it's crazy that we have made it so complicated to build a mine. Now, why do I say this? Well, because there's other places in the world where mines are getting built at light speed. Okay. There's a little, we'll call it a lithium mine that I know about. And that aerial shot that you see there, it's kind of stitched together from Google Earth. That thing was built like that. Okay. It was built in unbelievable short amount of time by Chinese. Okay. You want to know why the lithium price cratered about a year and a bit, I think, because the Chinese turned on the spigot on some of these big projects in South America primarily. And there's so much lithium puking out of these things. It's crazy. Okay. Again, they've developed their own supply chain, smart move on their part, and we're sitting here scratching our navel, trying to figure out, how do we get enough copper for the next, 10 years of electric, whatever. It's like, come on, guys, we're a joke. Okay, go to the next slide. Okay, we have different objectives. Okay, I don't really think I'm going to stick my neck in. I'm going to say a lot of countries, the whole green energy endeavor is not really what's driving them. It's more about what I talked about way back a few slides ago, about them wanting to control and create wealth for themselves. Okay. Okay. So what do we have here? Well, that chart on the left shows copper demand increasing because of various green energy initiatives. Yeah. Yep. That's our traditional Western view of everything. And it will increase. I mean, now we got AI driving it too, whatever, but my point is, we think green energy in the West. Chinese are thinking about controlling industries and protecting their own industries. Everybody talks about rare earths like they know what they're talking about, and it's the dumbest thing. I've been in rare earths for a while because I had a project where I worked with the Japanese government. The rare earths are not rare. First of all, they're all over the bloody place. It's about you got to produce a product that's usable by industry. Okay, and it's got to be low in radioactivity and da 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 da. Again, for a long time, the only significant source of rare earth metals that made sense was out of China. The clay type or ionic type rare earth deposits in China produce a very clean product that can be used by the refiners of rare earth around the world. And because they had all of that deposit in their own country and that product in their own country, not only could they export it on a very controlled basis to other countries to kind of control their industries, but they also kept a lion's share of it, and they used it to develop their own industries and manufacturing that use rare earths. Okay, smart, brilliant. Okay, but they're not rare, guys. Okay, now there have been some recent discoveries of ionic type clay deposits elsewhere in the world, and if we see those developed, I think you'll see that dynamic change. I think China will lose control over rare earths, and hence the industries that use them. Okay, but this just shows you the difference in thinking. We're thinking green energy. They're thinking about controlling industries and creating wealth. Okay, go to the next slide. Now, that's just a little piece of a much bigger story. And I just threw those slides in there to get everybody thinking. I'll probably talk more about this over time. There's other impacts that that has had on the world. Anyway, I'm going to give a few updates here. I'm going to put my skates on and get going here. Go to the next slide. Some really good ones. So Magotes put their first news release out since going public this week. This is from the Vicuña project, or Filo Sur project rather. And this project, if you remember, is immediately, like, seamlessly attached to the Filo exploration story. So you can see on the map on the right, Filo del Sol, which is Filo mining, which is 3 billion Canadian, I think. And you can see the geophysics and the chemistry go straight down onto Magotes. Do I think they might have a discovery or two? Heck yes. Okay, very simple thesis to be had right here. Let's go to the next slide. Okay, now the company announced their first data from work they did prior to going public. So they were actually doing some work, I think, back earlier this year. They wanted to go in and drill a bunch, and unfortunately, they only got 2 holes drilled and 1/2 of a hole before the snow chased them off the hill. So they got 2,185 meters drilled. There's a couple holes in for assay. We'll see what those assays look like. They don't have them yet. But this news release mainly talks about some very technical exploration success that they've had on some of their targets, like Filo Algunita and this Rincon target and so forth. I don't want to take 20 minutes to go through the technical bits. This is a very dense, we'll call it technically dense news release, but I'm going to give you a little bit of a flavor, to spoon feed a few points to take away. Go to the next slide. Okay, this comes from the Colorado target. I believe it's Nueva Colorado target. And if you want to reference things, you just go back a couple slides. Okay, but these are pictures of outcrop and on the top, and then down below, out of core from the property. And I'm telling you, actually, a lot of those might be core as well. Never mind. Anyway, there's some rock samples and there's some core photos in here. The linear ones are also core. Sorry. Look, guys, any geologist that looks at this stuff gets excited. Okay, you see rock that's been hammered. Okay, volcanic rocks, porphyries that have been hammered. Lots of silicification, meaning hydrothermal silica, quartz that's been flooded into the rock, but also gobs and gobs and gobs of sulfides. Pyrite, chert, but chalcopyrite, that's a copper-bearing sulfide. You see blobs of bornite. Who doesn't love bornite, Kevin? You see blobs of cobalite as well, which is another copper sulfide. Okay, what they're trying to say here is, in my view, they're saying, hey, we're near something, because look at all this stuff we've seen. Did they really discover something just yet? I don't know, because the assays aren't back, but we'll find out soon. If anything, this is a near miss, is my best guess, or otherwise, I think that, knowing the people, I think they'd be beating their chest going, oh, we've made a discovery, blah, 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 blah. I think we're going to see some very interesting results, albeit, high level anomalous, or, maybe more than that, maybe incipient discovery level type stuff, we'll call it. Okay. So my view, good. Thumbs up. Go to the next slide. Up here at Filo and Algunita, they found an area where there's this mineral called alunite. And everybody might say, who cares about alunite? Well, alunite happens to be a mineral that forms from very acid fluids at a very shallow level above a porphyry. Okay. So what they're saying here is they found a gigantic, what we call lithocap, that's got alunite scattered all through it. And it's created by SO2 rich fluids. So sulfuric acid rich fluids that have risen off of a porphyry at depth and just absolutely cooked the rock. Okay, so they're trying to say, hey, we found an epithermal cap or a lithocap to a likely porphyry below. This is also quite exciting. What might be in this? Well, oftentimes the gold actually kind of moves up into this part of the system. So I wouldn't be surprised if when and they did get some results. I think they have some assays, rock chips from here that are pretty good in gold. But it's really good indication. Again, thumbs up. Let's go to the next slide. Okay, and then this is Filo Sur Project Camino. This is a little bit further south, but what they found in this Rincon geophysical target, you can see the blue labels there. They were putting a road up, and lo and behold, they found extensive stockwork veining in this road. That I would say, looking at the texture and the style of the veining, is probably just slightly towards the top of a productive porphyry system. Okay, and not only that, but they have assays and stuff here that support that. Okay, but to actually see the stockwork veining in the road cut gives you a very high confidence that there's probably something brewing right below there, not too far, maybe 200 or 300 meters too, right under their nose. Okay, so once again, very good results. Go to the next slide. Okay, we got to move here because I got a few more. There was a big week this week. Okay, so PJX announced they got the drill permit. Long story short, we are now going to find out if PJX, which I talked about back in April, I think early April, if they have a Sullivan type discovery. Okay, Sullivan being one of the largest SEDEX deposits of zinc and lead and silver on Earth. It's up in British Columbia. These guys are just a few kilometers away from Sullivan. They found in outcrop rock that looks identical to Sullivan, and now they're going to go drill it. Okay, this is one of the most exciting drill stories I've seen in the base metal space for many years, and I'm very anxious to see what they hit. Okay, so we have a drill story to look forward to. Go to the next slide. Okay, Intrepid put out news this week. I believe these are the last assays they have from their drill program. They drilled, I think, 24 holes or something. I can't read all that small stuff. Don't worry about it. I don't want to take the time. But you can see the results. They got some very good assays here. Long runs of good values, like 0.53 gram gold over 112 meters. Silver is pretty high too, but also the copper numbers are quite good in there, 1.5%. Okay, but inside of that, there's some even higher grade subminerals. Okay, now everybody's been screaming about where's that cross section. I want to see this thing in view. Okay, so I happen to get my mitts on a Leapfrog model. Thank you very much, company, for providing. And we're going to have just a quick look. And I'm going to share, present, whatever, share screen. We're not going to take too long, guys. I'm sorry. It's going long. There we go. Share. Is that visible?
Not yet. But wait a second. Just stay there. There you go. Done.
Is it? Okay. All right. Okay. We're gonna look straight down on this thing to show fairly wide space drilling. Yes, there is historic drilling through here, but this is a fairly wide space drill array over a distance. You can see the scale bar down in the lower right here of about 3 kilometers. Okay, that's a pretty long stretch to put 24 holes. But I guess the first thing I would point out to everyone is that every single dingle hole in this drill array hit mineralization. Okay, if I zoom in over here, you can see, there's copper and gold assays in each one of those. In here, yep. And then over here, yep, there's one. And then over here, sure as heck. Okay, so basically all holes hit some significant mineralization. Okay, now this is a little bit confusing to look at. We're at the south end of the drill array, by the way. All right, it's a little bit confusing because you got both copper and gold on the image here. And I can't separate them the way they sent it, unfortunately. So you just got to kind of put up with things. But basically, the little color bars, the circular color things on the drill color or drill hole itself, that's gold. And then these little pink wingdings sticking out here, pink and red wingdings, those are copper assays. Okay, this is not a porphyry. Okay, if this was a porphyry, you'd probably just see relatively continuous, smooth, whatever value distribution of values. This is an IOCG, in my view, very strong view. Okay, there's iron oxides there. There's sodic alteration, other geo crap that you don't want to hear about right now. But basically, I think this is a Bisbee type discovery. Okay, now while the company focused on just a few little isolated areas here, the scale of this system is quite big. Okay, this right here is the deepest hole on the project. So I'm going to close that. And it hit pretty good grades. Okay, I would expect to see rather nuggety or potty mineralization in a system like this. It doesn't bother me because Bisbee ended up being a fantastic mine. I think this could. It's very high grade, actually. Okay, in other words, the way to think about this are pods and lenses of very high grade mineralization scattered through broader low grade instead of a porphyry, which would become a more uniformly lower grade mineralization. So it's a good outcome in my view. If we scroll along and we just look, look at this. There's actually some pretty good values. Like look at these holes here, right up at the tippy top. Maybe they drilled away from something. They got away from it down here at the bottom. I don't know. There's still, still going to take some detail to put this all together. Hopefully the company puts together a few more cross sections and whatnot to help us understand. But even up here at the northern end, we can see some very high grade pods and areas within the drilling, and every single hole hit. Okay, so that's encouraging in my view. It's got kind of the footprint in the deepest, by the way, that's only 300 meters. Okay, this is 3 kilometers by deepest 300 meters. Do you think it just magically cuts off at that level? No. A system that's 3 kilometers long ain't going to cut off where they stop these drill holes. I would love to see the company start testing a deeper regime down here to really show that this project has scale to it. Okay, all right. Let's go back to the deck. Sorry about that, guys. Whoever's driving the bus here, put that deck back up, unless I'm missing something.
1 second. There
we go. Okay, next slide.
Looks like we need. There we go.
There we go. Barksdale. Okay. A while back, I said, I'm going to get my hands dirty and going to work with Barksdale to get stuff going. Okay. Get shark going. That's our motto. All right. We have inserted into Barksdale an exploration geologist I've worked with for many years, Alan Roberts. He helped me drill Springpole up in Ontario back in the 2009, 10, 11 era, I think. We drilled 5-point-something million ounces. Sharp guy, knows how to operate. He's about my age. Very hard to find geologists in this age range right now. But when Alan told me he was available, I said, hello, I got a position for you, buddy. He knows how to drill difficult holes, which is what they encountered down there, difficult drilling conditions. Alan will run circles around this. I'm very confident, and I'm glad to see him take this role. Go to the next slide. Okay, BCM, another one I like to get my hands dirty with. Look, I pushed them to work with Colorado School of Mines. In particular, this group, this KSAM group, I can't think of the acronym, what it stands for, but basically it's a bunch of very, very smart professors at Colorado School of Mines, along with their graduate students, and they deploy them out into the mining industry to do very, what do they call it, very focused exploration advice and modeling. Okay, and they've done that work here at BCM at Thompson Knolls. Okay, basically they spent the better part of the past 2 or 3 months relogging the core, studying things in detail, and now they have a very good handle that at Thompson Knolls, the best vector is probably to the southwest, and this is what we need to know so that the company can get back and get some money in the bank and start drilling and doing big things. Because I'm telling you, I talked to a lot of people, and everybody that's looked at the data that's come back from this so far says there is something big here. Okay, very big. These guys are onto a discovery. Sergei Dyakov was the discoverer of Oyu Tolgoi. He's no dummy. Combining him with these guys and their brain power, we have a story to tell now. Go to the next slide. Okay, this is a map of the property area. The circle with the blue dots in there, that's where they drilled both. There's the drilled holes as well as the planned holes that they have in open circles. But then they also extended their drill permit to this area off to the southwest in the yellow polka dots that you see. Those are all planned drill holes. Okay, why are they down there? Because there was a magnetic anomaly that showed up down there. And thank goodness that they expanded the permitting in there, because guess what the guys at the Colorado School of Mines found? They found that the copper and the gold and whatnot is trending. It probably goes down in that direction. So these guys, they need to drill more. Go to the next slide. The model shows them this. Okay, it basically says that the drilling they have at present is out on the fringe of a skarn system. The porphyry is obviously the purple thing there. The big purple blob is the magma source of these metals, and the fluids emanated from those outwards into the limestones surrounding. Okay, but holes TK8, 6, and 14. And by the way, TK8 is a discovery hole. Hands down, it's a 100-gram meter plus hole. Okay, they were on the fringe. Okay, so the idea here is they need to work their way back towards the porphyry. But where's the porphyry? Okay, go to the next slide. Okay, so the guys at School of Mines, they did this modeling, geochemical-based modeling, that basically says the fluid source is down there in the southwest and leaked fluids up towards the area that was drilled. Okay, they need to go back down to the southwest. I think if they drill a couple holes down there, I think we could see a massive, major discovery. That's my view. Okay, and I'd love to see the company get back on its feet, get some cash in, and drill these holes. All right, go to the next slide. Goliath is drilling. Look, a couple of weeks ago, I talked about them in detail. I'm not going to go through all the targets. This map shows you where they're going to be drilling this year. It's going to be exciting because they got drilling to follow up at Sherbet. That's great. But they're going to test this jackpot target where they hit very, very high-grade gold samples. They got samples off surface last year. They're also going to drill to the north at Full Contact and Treasure Island as well. This will be, I put a quote in here, this will be a year of discovery, like expansion. This is a project where the trend is always persistently in the right direction. So I think they're going to have a very good this year. Go to the next slide. Okay, Kingfisher. Look, I talked about them like a few weeks ago. You know what? I'm gonna tell you this. Okay, for people that wonder, do you lose interest in the company or something if they don't hit? Well, yeah, I mean it's disappointing. Okay, but when we see a young team like Dustin and his team, and we see the energy to make what I'll call a pivot, okay, to go from a project that didn't quite work for them to a new project and put all this time and effort in and really cut some really attractive deals to build a commanding land position in the Golden Triangle, I think is brilliant. Okay, so kudos to them. This is now becoming more and more of an exciting story for us. Also, other shareholders. There's other shareholders in Kingfisher, certain gentlemen in Peru who everyone knows on this call, who are very excited about what's coming here. Okay, I think they're going to knock it out of the park. Okay, go to the next slide. We're almost there. Almost there. Okay, SK, a lot of people have asked me what happened with the P2 gold agreement. In short, in May or whenever they kind of reached agreement, I can't remember when it was announced, I think early May, it looked like the market was picking up and that there would be access to capital and stuff. And unfortunately, that didn't crystallize. I'm not saying, it was a bad move or whatever, but it was just clear that it was going to be a struggle to see the two companies combine and then try to leverage a cash raise and capital to do work at this time. And there's some times in life where you just got to go, you know what? Let's put things on hold a wee bit. But fortunately, SK has like 2.4 million. Okay, so what they've done instead is they've asked the exploration team at P2, which by the way is the same team I talked about, Ken and so forth, that discovered Bruce Jack very nearby, okay, the mega gold deposit. Okay, here we are. We're in a place where you've got an exceptional team that has a bit of cash. We're not going to spend much, like 400,000 maybe, to go out and hit the property hard along with some of our existing team members. And we're just going to see what they come up with. This isn't a bad thing. This is good. Okay, go to the next slide. Newfound had a couple of news releases. One was the acquisition of Lab Gold's ground. Kudos to them. I mean, now they got control over pretty much the entire gold belt through that region. But they also announced results from their deep drilling, and I want to talk about those in particular. Go to the next slide. Look, this map simply shows the Keats, Lotto, etc. gold trend down there towards the bottom center with the blue polka dots, and then the blue ground that's been brought in. That's Lab Gold, and you can see there's gold occurrences along that. And with that consolidation, now they control much more of the trend. There's just one little gap right there towards the north end of Lotto and stuff. but otherwise they got the whole shebang. Go to the next slide. Okay, this week they talked about some of the deep drilling. This is the first deep drilling that's happened at the Keats, the North Queensway area. And these intercepts that you see here with visible gold, they look exactly like the visible gold we see in the drilling they've done to date up at shallow levels. But these holes are down hundreds and hundreds and hundreds, even 1,000 meters. Okay, and they're seeing same style of mineralization at depth. Now, did they hit a home run with these holes? No, but think about it. You're basically poking a hole way the heck down there, based on maybe your seismic data or whatever. On the first pass, holes can kind of wander around and do all sorts of things. But on the first pass, to hit visible gold like this, that looks just like what you see up at top. That says something. Okay, it says the system's alive and well, and there's much more to be found there. Go to the next slide. Okay, so what they're showing in this image is a long section of the North Queensway project, and you can see the areas that have been drilled in red there. That's basically the model of the various veins. But now you see the deep holes, and where they've hit mineralization, there's little flags and tags that show you there's mineralization another double down. Okay, so the depth to the bottom of the red, you double that again, and it's open it up. It's proof that the gold's there. I'm not surprised because these systems, they're orogenic. They probably came from 20 kilometers down or something. And I wouldn't be surprised if we see this thing go down even much further. But now we have proof. All right, let's go to the next slide. So it's like this, guys. Think of the plumbing. The fluid's trying to get out of the ground is plumbing, and you have this very complicated plumbing. And up to this point, they drill down, say, to that red line, and those are all the different gold zones. Okay. Now they have, a few holes. I think 4 holes or whatever between the red and the yellow lines that show the system goes down to that depth, but it will keep going. Okay, that's my analog to what's going on at Newfound. All right.
Wait, that's Awesome's live, by the way. No way to describe
well,
it.
you can also kind of get an understanding. Like if you're drilling a hole, you're going to hit a pipe or you're going to hit a gap between the pipe. They hit some pipes. They nicked or whatever you want to say. They had assays up to 50-something grams. Like hello, that's crazy. Everybody wants instant gratification. Well, guess what? Science doesn't often generate that, but whatever. Go to the next slide. Okay, and I grabbed this news release right before this. Is part of the reason it delayed is because I noticed this came out today, and it's good news in my view. Okay, Lion One announced they recovered 3,550 ounces of gold. They poured, there's a series of steps that go through processing, but they poured 3,250, I think it is, or something like that. And they got that out of 32,000 tons, so basically a 10th ounce per ton. And everybody says, oh, that's kind of low grade. Well, guys, remember that most of this rock, probably there's 3 months in this quarter, right? So most of that rock, probably the first 2 months, is actually development rock, which is lower grade. And then just the past 3 or 4 weeks, I think they've gotten into stopes where they're into actual production grade type stuff. But the chart that you see of production increasing is very dramatic. Okay, they're at like a run rate of 1,500 plus ounces per month right now, and increasing. Okay, where that lands, I don't know. But if that trend continues, I think they should have a good outcome here. Now, the thing that always spooks me about companies that are trying their best to get a mine going, and they have lenders and stuff. Lenders are a pain in the nads, to be frank. And I don't want to see any problems pop up from their lenders in the process. Okay, sometimes some people can be a little predatory with a company, and I don't want to see that in this case. Anyway, that's it. Okay, done.
Kevin.
All right. Thanks, Quentin. That plumbing that you showed at the end, what kind of plumber would build something like that? What
I think that was a piece of artwork. It's
Christmas tree light message.
It's artwork somewhere. But it's just such a cool picture,
To Quentin's point, sometimes you hit a pipe, but sometimes you can hit a joint as well.
Yeah. Golden joint.
Sorry. It's Friday. I had to throw this one in.
I get it. All right.
Okay.
So, well, fantastic. Thank you, Quentin. Thank you, Tavi. I said we'd have Merrick's contact information at the end, and here it is. He's head of our investor relations at Crescat. If you're interested in learning more about our strategies, please do reach out to him. His phone number and his email address are right here, and we encourage you to do that. It'd be a good idea, I think, because the timing just looks incredible right now for what we've been calling the Great Rotation. We even had Bloomberg and other people, referring to the big rotation, the Great Rotation, yesterday, because it was a rotation yesterday out of mega cap 7 and into practically everything else. But I do think it's the beginning of the end for the Mag 7, and we saw them all sell off again today into the close.
Kevin, you muted again. I'm
You
not
muted
sure what
yourself.
happened.
You
I don't-
muted yourself.
Oh my God, sorry. I don't know how long I've been muted.
Not
Just a
long.
second. Just a second.
So the Mag 7 sell-off towards the end of the day today was quite interesting because there was that early strength in the day, and then the last hour, everything kind of melted down a bit. Some of the stocks were still up on the day, but I think you're definitely seeing this weakness, this rotation, the weakness in the Mag 7 that has been the leadership group. Yeah, there's the chart. Thank you, Trevor. This is what we saw yesterday. I don't think anyone could have imagined, anyone who's been long the S&P 500 index or these Mag 7 stocks could have imagined this, could happen. We've been waiting for it for a long time. It's overdue. But disruption. AI is a wonderful technology, but it is creative destruction. And there are a lot of new up and coming companies that threaten these monopolistic large cap business models at record margins, record historical growth rates, record valuations. These are how market tops are made on the excitement. It's just how the tech bubble top in 2000, how that top was made, all the investment going into this area. And there's hundreds of millions of dollars being spent on NVIDIA, GPUs, and other data centers and so forth for this AI race with no business plan in sight on how to get a return on that capital. It's just a big race to spend money. This is how the tops in capital investment cycles are made that also coincide with the tops in market cycles, business cycles, economic cycles. And we're in a very critical one right now, transition out of this mega cap tech bubble into a broadening out in the market. But we think it's a more narrow group of stocks ultimately that people will be rotating into because of the inflationary problem that we have today. But a great setup for a commodity bull market, for a precious metal strategy. Look at those charts that Tavi showed you earlier in this presentation, how cheap the mining stocks are relative to gold itself. And the timing couldn't be great. So we do encourage you to reach out to Merrick. That's all I have. Tavi, any final comments?
No final comments. So, all right. Well, if you have any questions, please, I would say contact Merrick. And that's his information right there. Thanks, Trevor. His email address, his phone number, and also his name. So if you have any questions about what we do, I suggest you to speak with him. Thanks, everybody. We're going to be back next week with another presentation. If you like this video, just follow us on YouTube, and you will be notified of our upcoming videos. Thank you so much. Take care. Have a good one.